And what do we look for within our two styles? Because they do bring two completely different things to the party, albeit they are two sides of the same coin. Ultimately, you're both trying to buy an investment for below what you think it's actually worth. For growth, these are the things you would expect: high returns on capital employed, an identifiable moat, which gives them this competitive advantage that is defendable and comes with pricing power. These growth companies are often very high quality businesses which throw off prodigious amounts of free cash flow, which can be reinvested at high rates incrementally of return. These are your fabled compounders. There's a lot of compounders that are called compounders that actually aren't. It's just because the PE ratio has gone up quite a lot. They look like compounders, but they're not. There's not actually that many businesses that can take or generate historic returns on capital employed, say of 30%, and actually reinvest all of those cash flows back into projects that continue to generate 30%. Think of it as a high interest bank account. You're earning interest on your interests. So you want to own these for very, very long periods of time, 5 years plus. We want strong management teams with a proven ability to allocate capital well. And we also favor market leaders with a multi-year growth runway ahead of them. When it comes to value, we don't mind cyclicals and we won't shy away from them, but only cyclicals with a quality balance sheet and an identifiable end market tailwind. You don't want to have a cyclical which is highly operationally geared when it's highly financially geared as well. You'll be on a road to ruin very, very quickly. If they are turnaround situations, we want a new management team in place for at least 2 years with some evidence that that turnaround is gaining traction. We want to see a potential to improve sales, the costs, their profit margins, and ultimately their cash flows. For special situations, we want to see a clear catalyst that the price earnings ratio can recover back to either its historic average level or from maybe 7 or 8 times, maybe to 12 or 14 times. And very, very rarely, sometimes we can identify a stock that's trading like a value stock today, which actually turns into a growth quality company later on in the future. And as a final overlay with value, it's absolutely essential, and this has helped us avoid value traps. The majority of low PE stocks on AiM are overpriced. To help avoid getting involved in value traps, we'll only put an idea on the buy list where the share price has risen above its 200-day moving average. There is momentum coming through. There is a turnaround, there is a recovery here. A lot of stocks or a lot of turnarounds never turn around and ultimately go to zero. Think of it like a plane hurtling towards the ground. What you want to see is pulling up before it hits the ground, and that helps. So by having a foot in both camps, it helps with our diversification. To give you an example, on a growth stock, this is one we invested at IPO a couple of years ago. So its market cap now is 440. At IPO, it was only 60 million. Too small for a lot of our bigger peers to look at. This provides foreign exchange hedging programs for small and medium-sized businesses. Why we liked it, the culture was incredibly strong. I spent at least 30 minutes of the call talking about the subtleties and uniqueness of its culture. The insiders own 50% of the company. There is scope, I believe, to drive revenues over the next 3 to 5 years to 100 million from 35 million at very high operating margins of circa 40%. The management team are always challenging themselves and are highly innovative. They're developing their own fintech, AlphaPay, which is a payment system. And when you're dealing with the high street banks, if you're an exporter with multi-jurisdictions abroad, it's very, very painful trying to sort out payments in different countries. AlphaPay reduces all of that friction. I actually think it could be as important, as big a part of the business as its core businesses today. We bought that at £2 at IPO, currently £11, and we remain a buyer. On a 5-year view, we still see tremendous upside from current levels. Give you an example of a recent value addition at DX Group, which is a delivery services company, parcels, freight, secure items, and logistics. 111 million market cap, this one, so it's right in our sweet spot. Highly experienced management team. This is a turnaround. They've been in place a number of years now, and there is evidence that they are turning this around at pace now. They came with tremendous experience from Tufnells, which is a competitor, which they managed very, very well before its sale. to a company who didn't manage it terribly well and sold it for £1 recently. They also, good alignment, the CEO has spent millions of pounds buying shares out of his own pocket in the market. They've repaired the balance sheet. That's paving the way now for the distribution of a dividend, I believe, within the next 18 months. And we will invest in a company today, even if it's not paying a dividend today. That gets us in ahead of income-only investors who are precluded from investing ahead of that actual dividend payment. They've shed loss-making contracts. And what we like about them is with this online delivery boom at the moment, most of their competitors think the DHLs and the Hermes of this world are running above capacity. They don't have enough drivers. Whereas DX Group are one of the very, very few national players. So they have scale to be able to deliver these contracts, and they can almost name their price on the contracts now they are signing. There's a 25 strong development team, software developers. It's almost a software company as well. And there's a lot of operational efficiencies still to take out of this business. I actually think operating margins could come in closer to 10% over the long term. Share price is currently 18 pence. If they execute as well as they could or should, it could be £1 ultimately, that share price.